$3,200 a month. That was the number Marcus and Elena wrote down at their kitchen table in Mississauga, the monthly budget they needed to retire comfortably in Lake Chapala, Mexico. They had done their research. They knew the cost of living was lower. They had a beautiful rental lined up near the lake, a community of Canadian expats nearby, and a plan that looked, on paper, like it should work. But there was one number they had not checked, not because they were careless, because nobody told them to. Canada's retirement system has rules that most financial planning articles never mention. Some of your benefits follow you across the border. Others stop the moment you are outside Canada for more than 6 months, and one of them can disappear completely. Not gradually, not with a warning, but as a hard stop, starting on the day your 7th month abroad begins. I remember sitting down with a couple just like Marcus and Elena who had already booked their one-way flights, only to realize their monthly budget was missing, a gap they could not recover without coming back to Canada. For Marcus and Elena, the question is not whether they can afford Mexico. It is whether the retirement income they planned around will still be there after 6 months. So which benefits cross the border with you, and which ones vanish? The answer starts with the most fragile benefit of all, the Guaranteed Income Supplement. The Guaranteed Income Supplement is, in simple terms, a monthly top-up from the federal government for lower-income seniors who are already receiving old age security. It is not a pension you earned through work. It is not something you paid into. It is a residency-based benefit. And that distinction matters enormously if you are planning to spend significant time outside Canada. The rule is straightforward. If you leave Canada for more than 6 consecutive months, your GIS payments stop, not reduced. Stopped. Service Canada tracks departures through CBSA exit records, and the clock starts from the day you leave. In Elena's situation, she qualifies for GIS because her and Marcus's combined retirement income is low enough to meet the income test. At the Q1 2026 rates for a spouse of an OAS recipient, she receives $668.08 per month. That money is in their $3,200 monthly budget. It is one of the foundations the plan rests on. Now do the math on what happens if they stay in Mexico for 7 months. 7 months of lost GIS at $668.08 per month is $4,676.56 in benefits that simply do not arrive, and it is not a one-time penalty. Every year they spend more than 6 consecutive months outside Canada, the same gap opens up again. One thing worth saying clearly here, losing this benefit is not a sign that Elena planned badly. She is not being penalized for doing something wrong. The GIS is legally structured to support Canadian residents, people who are physically in the country. The moment you are consistently living elsewhere, you are outside the scope of what that benefit was designed to do. There is also a detail that catches a lot of people off guard. The 6-month GIS rule and Canada's 183-day income tax residency rule are 2 completely separate tests. You can remain a Canadian tax resident for the full year and still lose your GIS. The GIS clock measures consecutive days outside the country, regardless of what your tax return says. If GIS is the benefit you lose first, what about the pension you actually paid into your entire working life? The Canada Pension Plan operates on completely different rules, but there is still a catch worth understanding before you book the flights. The Canada Pension Plan is built on a completely different foundation. CPP is a contributory pension. You paid into it with every paycheck during your working years, and those contributions belong to you regardless of where you choose to live. There is no residency requirement to collect CPP once you qualify, and there is no minimum number of days you need to spend in Canada each year to keep receiving it. Marcus worked in Canada for 30 years. His projected CPP at age 65 is $950 per month. Whether he is sitting on a patio in Lake Chapala or visiting his sister in Vancouver, that $950 arrives on the same schedule. Service Canada will send it to a bank account in Mexico, Portugal, or anywhere else in the world with no reduction based on where you live. I do not know every detail of your work history, and I cannot tell you your exact CPP payout without looking at your statement of contributions. But I can tell you that Service Canada will send it to you anywhere, from Tokyo to Tuscany. The portability of CPP is one of the most reliable pieces of the retirement picture for Canadians moving abroad. That said, the gross amount and the net amount you actually receive are two different things. The moment you become a non-resident of Canada, the government applies a non-resident withholding tax to your CPP payments. So while Marcus's $950 is protected in full from a benefit standpoint, the check that actually lands in his Mexican bank account may be smaller, unless he takes a specific step, which we will come back to in a moment. So CPP is safe. GIS is gone after 6 months. That leaves the most widely misunderstood benefit in this entire picture: old age security. And this is where most Canadian expats make a mathematical mistake that costs them far more than they realize. Old age security is where the real complexity lives, and where the most expensive planning mistakes happen. Most Canadians assume that once they have lived in Canada long enough to qualify for OAS, they can collect it anywhere in the world. That is partly true, but the rules have a level of detail that almost nobody explains clearly, and that detail can mean the difference between collecting a meaningful check every month and receiving nothing at all. There are two separate tests to understand. The first is the portability threshold. To receive OAS payments while living outside Canada, you must have lived in Canada for at least 20 years after age 18. That is the minimum to keep receiving OAS once you have been abroad for more than 6 months. If you do not meet the 20-year rule, your OAS stops when you leave. The second test is the calculation formula. Full OAS is based on 40 years of Canadian residence after age 18. If you meet the 20-year threshold but have fewer than 40 years, your payment is prorated. The formula is simple. Your years of residence divided by 40, multiplied by the maximum OAS amount. Marcus lived in Canada for 22 years after age 18. He meets the 20-year threshold, so his OAS follows him to Mexico. But his payment is calculated as 22 divided by 40, which is 55% of the full benefit. At the Q1 2026 maximum of $718.24 for ages 65 to 74, Marcus receives $395.03 per month, not $718.24. Their original budget assumed something much closer to the full amount. Elena's situation is more difficult. She lived in Canada for 18 years after age 18. She does not meet the 20-year minimum. The moment she has been outside Canada for more than 6 months, her OAS stops entirely, $0 per month, even though she would have received 45% of the full OAS, $323.21 per month, if she had stayed in Canada. Years ago, I used to think that once you hit the 20-year mark, you unlocked the full OAS benefit abroad. That was wrong. The 20-year mark is simply a gatekeeper. Your actual monthly payment is still prorated based on how many of those 40 qualifying years you actually accumulated. There is one more piece here that confuses people. Canada has social security agreements with over 50 countries, including the United States, the United Kingdom, Portugal, and Mexico. Under these agreements, years of residence or contributions in the foreign country can sometimes be counted toward the 20-year qualification threshold. So if Elena had previously lived in Portugal for 5 years, those years might help her cross the 20-year eligibility line. But here is the gap that most people miss. Those foreign years only help you qualify. They do not increase your monthly payment. Elena's Canadian payment will still be calculated on her 18 years of Canadian residence only. The agreement gets you in the door. It does not change what is written on your check. So Elena loses her OAS entirely once she leaves, and Marcus gets a prorated 55%. But before that money even reaches their Mexican bank account, the Canada Revenue Agency takes its cut, or does it? When Canadians learn that a 25% non-resident withholding tax applies to their CPP and OAS payments once they move abroad, the reaction is usually the same frustration, followed by a sense that the system is stacked against people who choose to leave. That reaction is understandable. But the 25% figure is widely misread. Under Part 13 of Canada's Income Tax Act, the default rule for non-residents is a 25% withholding on Canadian pension income, CPP and OAS included. Service Canada withholds this amount before sending the payment. So Marcus's combined monthly income of $950 from CPP and $395.03 from his partial OAS adds up to $1,345.03. Under the default rule, 25% of that, or $336.26 per month, is withheld automatically. He receives $1,008.77 instead of the full $1,345.03. That is a meaningful reduction. But here is what the 25% withholding actually is. It is a prepayment, not a final tax bill. Non-residents who receive Canadian pension income have the option to file a Canadian tax return under Section 217 of the Income Tax Act. What that filing does is allow the CRA to assess your Canadian source income at normal graduated tax rates, rather than the flat 25% default. And because Marcus's total Canadian income is relatively modest, roughly $16,140 per year, his effective Canadian tax rate after personal tax credits would be close to zero. Filing under Section 217 allows him to recover most or all of the $336.26 withheld each month. There are also tax treaties to consider. Canada's tax treaty with Mexico, like treaties with many other countries, may cap or reduce the withholding tax rate directly at source, even before filing season. The Section 217 election is not automatic. You have to file a return each year to claim it, and there are specific deadlines and conditions. But for retirees like Marcus, whose Canadian income falls well below the basic personal amount, it is often the difference between receiving $1,008.77 a month and receiving something close to the full $1,345.03. The key takeaway is this: the 25% withholding is a default, not a destiny. With the right filing, it becomes a refund rather than a permanent loss. Filing a Section 217 election can save Marcus thousands of dollars a year. But there is one more cost in this picture that no tax treaty can fix, and it is one that most people forget to put in their retirement budget until it is too late. There is a cost in this equation that tends to get mentioned in passing and then forgotten. It is not a tax. It is not a withholding. It is the cost of your physical health, and for Canadians in their late 50s and early 60s, it is often the number that decides whether retiring abroad is actually affordable. Provincial health coverage in Canada is residency-based. Just like GIS Ontario's OHIP, for example, requires you to be physically present in the province for at least 153 days in a 12-month period. Most other provinces use 183 days. If Marcus and Elena spend 8 months in Mexico, they lose OHIP. Not suspended, gone. Reinstating it requires moving back and waiting through a new eligibility period. Now imagine Marcus has a health scare while they are in Mexico. Without provincial coverage, the cost of hospital care falls entirely on them. Private expat health insurance for a couple in their early 60s typically costs between $300 and $600 CAD per month. That is before any claim. That is simply the monthly premium to have coverage in place. When you add that to the income losses Marcus and Elena are now facing, Elena's lost GIS of $668.08, Elena's lost OAS of $323.21, plus a mid-range health insurance premium of $500 per month, the monthly budget gap reaches $1,491.29. And this is on top of whatever assumptions they had already built into their $3,200 budget. Mexico's cost of living is genuinely lower than Mississauga. A 40% reduction in daily living costs is reasonable for many expat communities near Lake Chapala, but a $1,491.29 monthly gap in income requires a significant reduction in living costs just to break even, let alone come out ahead. This is not an argument against retiring abroad. Many Canadians do it successfully, but the ones who do it well are not working from rough estimates. They have run the actual numbers, including the benefits that vanish, the withholding that applies, and the insurance they need to carry. So how do you avoid this trap without giving up on the idea entirely? You need a specific plan, one that is built around the real mechanics of how Canada's retirement system works for people who leave. The good news is that most of the problems Marcus and Elena ran into are not fixed by giving up on Mexico. They are fixed by adjusting the sequence and the timing of how they leave. The first lever is the 20-year residency count. Elena has 18 years. She is 2 years away from the portability threshold that would allow her OAS to follow her abroad. If she and Marcus delay their permanent move until Elena crosses that 20-year line, she locks in lifetime OAS portability before they go. 2 additional years in Canada, or structured as snowbird trips, while she completes the residency count, protects a benefit that would otherwise disappear the moment she is abroad for more than 6 months. The second lever is the snowbird approach, and it is the most practical option for people who are close to retirement but not quite at the 20-year mark. If Marcus and Elena spend less than 183 consecutive days outside Canada each year, Elena keeps her GIS, they both keep their provincial health coverage, and they maintain their Canadian tax residency. This works well for couples who want to gradually test life abroad before making it permanent. The trade-off is that 6 months is a real constraint. It takes some of the spontaneity out of the experience. The third lever applies before they ever leave Canada. If Marcus has a significant amount saved inside an RRSP, now, while he is still a Canadian resident, is the time to start drawing it down in a deliberate, tax-efficient way. Once he becomes a non-resident, RRSP withdrawals are subject to the same 25% non-resident withholding tax. If he draws down the RRSP while still in Canada, paying tax at regular marginal rates, he can potentially move that money into a TFSA or a non-registered account, and it comes out later in retirement with no additional tax cost. There is also an emotional piece to this that deserves a moment. A lot of Canadians feel a kind of bitterness when they start doing this math. The sense that they built their working life in this country, paid into every program, and now the system is structuring things so that leaving means losing. That feeling is real and it is fair. Wanting to maximize benefits you worked your entire career to earn is not greedy. It is the same instinct that makes someone read the fine print before signing a mortgage. The difference between a frustrating retirement abroad and a successful one is usually not the destination. It is the planning that happened in the 2 or 3 years before the departure date. If this breakdown is helping you make sense of your retirement numbers, hit the subscribe button. We map out the real math of Canadian retirement every single week. Here is where Marcus and Elena actually stand once they understand the full picture. CPP is theirs to keep, regardless of where they live. OAS requires 20 years of Canadian residence to travel with them, and even then, It will be prorated based on actual years of residency, not the full amount. GIS stays in Canada the moment you are gone for more than 6 consecutive months. And the 25% non-resident withholding tax on CPP and OAS is a real cost. But it is a recoverable one if you file a Canadian return under Section 217. None of this means retiring abroad is off the table. It means it requires a different kind of preparation than most people expect. The Canadians who do this well are not the ones with the most money. They are the ones who did the math on the right numbers before they packed. You can still build an incredible retirement abroad, but the plan needs to be built on what your income actually is, not what you assumed it would be before you understood the rules. Subscribe to Brian's Canadian Retirement Playbook and let us build your retirement plan on solid ground.